My name is Thomas, and this is For the Common. All right, something that hopefully makes this channel a little different. I noticed while I was surfing the finance content out there that a lot of people will talk about stocks, but they don't really talk about their portfolio or let alone their trades. So here at FTC, I want to do things a little bit differently, and I'm going to reveal my entire investment portfolio with you all in this video series. Now, I want to be clear, the goal of this series is to be transparent. You all will be able to see exactly how I'm positioned, what changes I'm making in my portfolio, and more importantly, you'll be able to see exactly what happens to my portfolio over time. So this transparency will give me the opportunity to illustrate my thought process on positioning, on performance over time, and we can also take a better look at some of the investment opportunities that I'm analyzing. However, let me be extremely clear. Do not invest a certain way just because I invest a certain way. Do not buy a stock just because I own or purchase that stock. I make mistakes all the time, including losing $2 million over the last couple of years. So you need to do your own investment research, and you have to make an investment decision that's right for you depending on your own personal situation. So hopefully you'll be able to learn from some of my mistakes, and we'll be able to apply those lessons in your own investment style. And ideally, you'll avoid a little bit of the pain that I've experienced over the last couple of years. And maybe, just maybe, if we're lucky, we're going to have some wins along the way as well. We can share those, we can learn from them, and maybe that will give you a little bit of confidence to get out there, to invest in yourself, and to invest for yourself. So there are more disclosures listed below. I would definitely recommend checking them out. And with that, let's get to it. So what happened in this time warp since my last portfolio reveal video? Well, quite a bit, and most of it was bad. And I have a playlist that I'll put over my shoulder that highlights a few of my old reveal videos. But a little bit of context before I jump into this chart from Interactive Brokers, which is a little new. I started investing with this particular style sometime in 2016, 2017. And the real focus of the style is to invest in high quality companies that have good growth prospects, but also solid competitive advantages to be able to capture value over time. And I decided to do that after getting my butt kicked in 2013 to 2015, investing in value stocks that were cheap on a price to earnings ratio basis, and that were down a lot, which positioned me mainly in cyclicals with no competitive advantages. So why did I not just buy Google in 2016 and hold it for 10 years? I have no idea. But after losing a bunch of money in these cyclicals and trying options, which was also a fail for me personally, I had the chance to speak with some really successful investors because of my job, and I was able to talk to them about their strategy and also their investment process for success. And after that, I decided to do something super bold, which was go out and buy the stock of successful and quality businesses. Yeah, it's actually not that bold, going out and buying the stock of good companies. But for me, that was brand new. And since 2016 and 2017, that's been really my core strategy. Again, going out and finding good quality businesses and owning them for a long time. So at that time, I had a few $100,000 to invest, maybe 200,000, and I have put some money in the account over time. I'll start bringing this down. And I had some incredible results. Some of that was captured by this chart, but unfortunately I had some restrictions in my previous jobs that required me to keep my account in certain places, and that restricted the stocks that I could buy. So unfortunately, the information here is only back to 2019. As you can see at the top here, on August is when I brought my account over to Interactive Brokers. But for science and with this awesome performance that I was having, I wanted to see how far I could take things. And so I used a lot of margin, and I almost never trimmed or sold a stock. And I took my account from a few 100,000 back in 2013 and then to 2015 to here in 2019. I think I brought over about a little under 600,000 in 2019 in my account. And then you can see right before COVID, around $1 million. and then went down with COVID and then just came roaring back after COVID. And that's 1.5 in January of 2021. And then I ended right the end of 2021 with around 2.1. I think the high water mark was around 2.2 million. So had solid results. But as you can see on the right side of the chart, like any good experiment, I did find my portfolio's limit when everything rolled over with the increasing inflation, the Fed's quick action to raise rates, and worries about the economy. So yeah, the market tumbled, my account got crushed, and there were days I was losing $200,000 in a day, which was crazy to see. And I saw these really incredible businesses in their stocks that had done really well just absolutely get crushed and go to prices that I never thought I would see again. So the market got crushed, so did my portfolio, and with some unique circumstances and some stupidity, a lot of stupidity on my part, I had a lot of that stock on margin. So as time went on and the market fell, I was margin called and margin called again, which forced me to sell stock at much lower prices than I had bought, which caused me to essentially lock in some of these losses in the decline. So it went from 2 million down pretty dramatically to around 200,000. So a 90% decrease. And I have some videos explaining margin for those of you that don't know that financial topic. And a PSA here, it's a tool that creates a lot more portfolio risk and can be hugely detrimental. Case in point, my portfolio, and can hurt you. So you probably don't need it and shouldn't use margin in your portfolio. I just use it because it aligns with my risk tolerances, and it's likely not a good tool for you. But I was using margin and I got margin called a bunch. So I did the best that I could to do damage control, tried to unwind positions, but I couldn't do it quickly enough. And interactive brokers just sold off stock as they sometimes do, just liquidated a large portion of my portfolio and had a ton of damage, skipped along the bottom for the last several quarters. And, we would have some rebounds and I would try and make some moves in my portfolio, and then it would fall again. I would get margin called and then it would rebound. I would make some moves and then get margin called. So it was a tough time. And did I ever consider starting over again? Absolutely, 100%, especially when it felt like our house and our lifestyles were on the line. But I feel like that would have been the absolute wrong choice for me. An action for me, because selling everything would mean that I would eventually miss out on the rebound that's bound to occur. So I did the only thing that I could, think to do. I would sell portions of positions. I would try and get rid of the low conviction positions, reallocate to the best quality companies that I thought I could identify and that I had the most conviction in, and have slowly been trying to build back my portfolio over time and have larger positions in the companies that I really love to capture more of a rebound. So this process would kick off again. I'd get in a good spot and then the market would reverse and I'd get called, and I would just keep dusting myself off and trying to make progress on it. And so far I've been able to participate pretty well in this recent market rebound, back to, I believe, 400,000 in the account. But that gets us to how I'm positioned today, and I'll move on to that now. I think the most important thing to point out is my current margin level, which is still really high. If I jump here to my balances, you can see my negative cash balance is $565,000, which is a crazy amount, especially given the fact that my equity value of my portfolio right now is around $400,000 and has ranged from $400,000 to $150,000. So that's a ton of margin and therefore a lot of risk, which I would not recommend at all for anyone, including myself. And the only way that I can even have that much margin based on how much money I have in the account is because of where I started from, which is, again, around $2 million. And remember that I'm paying interest on all that money every single day. So they're paying interest, which I believe is around, I think around 7% now on $500,000 is a lot of money per year. So That is a lot of margin. That means my portfolio is going to have a lot of crazy swings for the positive and negative, and it's very possible that I'll do another video in a couple of months and be back to $200,000. But this is some of the performance, just percentage performance over time, which is why it's showing that I'm up 200%. Because of that margin, and with $500,000 worth of margin and $400,000 of work of my money, that's why it's showing I have about $1 million invested at the moment for both the margin and my equity. So I'm gonna jump here to the fun stuff, which is the stocks. And the positions that I have are really based on the conviction that I have in each company, and that's based on the company fundamentals. So a combination of the growth prospects, of the competitive advantages, and whether or not the company can beat competition, and also current valuation. So let me be clear, this is all just my opinion and how I'm positioned, and I can always be wrong, but I have it broken out into around, about 3 buckets. And the first bucket is my highest, overweights to my highest conviction and the best quality companies that I could find. And just trying to find as well a few with good growth prospects, but trying to anchor my portfolio in some really stable companies. So the largest that I have right now is in Microsoft, which I already have 40% gain in, pretty cool. They obviously have their Azure business, Office 365, great company. Costco's been on an absolute tear recently, another big position for me. And I'm already up 40%, which is also nice. This percent of net liquidity value, I would probably ignore that right now just because of my crazy margin position. I think of it generally more as just a total market value when I'm considering my position sizing. I also have a big position in NVIDIA that's up 200%. That's the one that I've been trimming a little bit just because it has grown so much. Apple, great, steady, consistent business. Salesforce, awesome software as a service business. You've got Google and Amazon here, also cloud businesses, with some other businesses that you all know, like YouTube for Google and like e-commerce, especially during the holidays for Amazon. And then maybe S&P Global, I'll say, is that first kind of bucket for me. And then the next bucket that I have are still really high conviction businesses, but maybe you're a more expensive valuation or that have higher growth. So a little bit lower conviction. That would probably be this bucket here of Atlassian, which makes Jira software and which also has Trello, if you're familiar with that. You got CrowdStrike, which is cybersecurity, one that I've owned for throughout this entire period. So I'm only up 4%, but that's better than being down 50 like I was before. Thermo Fisher in here. This is a slower growth and stable healthcare company. I've got Tesla, my famous stock that got margin called away from me, 2 years ago. I've got Datadog, a great software company that focuses on observability, and a number of ones in here. I can go through them fast, but Shopify, Adobe, Snowflake, Zscaler, MongoDB, Airbnb. These are more of the higher growth companies that are going to be a little bit more expensive. That's why I've kind of kept them lower in my allocation sizing. So these are around 22,000 versus 40,000 for Microsoft and Costco, but they're still big positions for me and ones that I really believe in is having great competitive advantages with their software, but also a great growth prospects. So, and then I do have some more kind of consistent performers in here with Accenture, that's consulting, Visa, the credit card processor, and then some ones like Trade Desk, which is marketing, ad spend, and then Boeing, Danaher. So Boeing's been doing really well. Danaher is good. Zoetis, animal healthcare, Union Pacific, railroads. So these are, again, more of those kind of lower of my tier, kind of second bucket consistent companies that I really like, but I maybe just don't like them or think they have the same consistency as something like a Costco or an Apple. But I think they're really important to have in your portfolio to make sure it kind of balances out some of the more growth-oriented companies. And then probably my last group here that are still really good businesses, but either have some challenges or just are expensive or relatively newer. That kind of starts here for me at around 16,000 with GitLab. So that's a software program that allows you to source code for writing software. And then UiPath, which is automation. So a big theme with AI, which is a really interesting company. Okta, single sign-on, that one's had a lot of challenges with hacks, but something that I actually personally used and like the software. Square, AMD, obviously semiconductors, great business, but a lot of volatility. Twilio, Unity, Raytheon's in here, or RTX, which is the new company, which is a industrial and defense company, but has had some issues recently with some of their engines, which is why it's a lower position. Estee Lauder, which has a lot of China exposure, so that's why it's also a little lower for me. I've got CoStar, Disney, Nike, which was down 11% after earnings, which that was a pretty big move, but still a company that I believe in, but one that's again a little lower for me in position sizing. Then I have some of the a little crazier, on the lower scale of my allocation, that are just higher, again, even higher growth or newer companies, and SentinelOne, Confluent, Intuitive Surgical, ARM, recent IPO, I'm a big fan of. DocuSign, I'm still figuring out what to do with that one. I've owned it for a long time, down 46%. But I think a good business, and there's actually talk of a potential buyout. Home Depot, Rivian, we'll see. I think they're the next Tesla's, maybe a bit of a stretch, but they'll hopefully at least survive. And I think the Rivian trucks are pretty good. And then I also have just a few here at the very end that are small positions that are definitely on the riskiest scale for me. So Amplitude, Upstart, Bill, Teladoc, which has been an absolute dog for me. I'm down 96%. Enphase, which is solar, and then Garmin. So that's my portfolio, just going through it, and you can see the cash balance there, the margin bit. And I think that's going to be my biggest change versus the last time I did this, which I'm really following these actually in process of trying to find good companies, position based on my conviction. But I think the thing that will be different is that I really hope to trim companies that do well over time. Whereas before, I almost never sold stock, which meant that my margin just over time, when I did add new companies, just skyrocketed. So when things turned south, I had nowhere to hide. So hopefully the goal will be, as the portfolio does well, to reduce this over time, but we'll have to see what happens. That could take years. But again, something that I want to keep in my portfolio to make sure that I can participate more in the rebound. So attuned to that, I did make some recent trades. I'll pull that up real fast here if I can find it. Perfect. Yeah, so these are some of the trades that I made, and I did do some trims. I couldn't help myself, and I did add to a few of the laggards that I've seen over the last couple of weeks because the market's been doing well, and there are some really high quality companies that I just can't live without and that have been left behind a little bit. But again, that plan is to eventually reduce the margin exposure and hopefully just kind of survive this volatility that we'll likely get in the next couple of months. So I did trim a little bit of CrowdStrike. I did trim a little bit of UiPath, but I have been adding again to those high quality companies that I thought had been lagging, like Apple, Thermo, Adobe, MongoDB's kind of been chopping around. A little bit of Trade Desk I wanted to increase my position in. Danaher, Estee Lauder, Raytheon I mentioned just a moment ago. And I also was adding to ARM, which again is the recent IPO, semiconductor platform IPO. So it really interested in that company after NVIDIA wasn't able to acquire it. And then I've also been adding a little bit more of Confluent because they had some issues with their sales team, just kind of restructuring. And I think that over time, that's still a really good company. So that's it. I will jump back to the portfolio and leave it on that. But as always, I really appreciate you checking out this video. If you have any questions about my positioning, or if you want to share how you are allocating for 2024 and beyond, absolutely let me know in the comments. I'd love to chat about what you like and what you don't like about my approach, and what successes and lessons learned you plan to implement into the new year. So up next, some more beginner topics is the plan, to really show and maybe recommend how I would help a new friend of mine who's starting to invest. It's been something that's been a common question. I also want to talk about what diversification means. And then finally, I want to try and talk about where we might be able to find some opportunity in this market, especially given the recent run that we've had. So thanks for tuning in. I appreciate your time as always, and see you next time.